Good morning and welcome to today's webcast, Not-for-Profit Accounting and Auditing Fall 2017 Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Thank you everyone for joining us today. I'm happy to introduce our presenters, Liz Dollar and Laura Roos. Liz, I will now turn the line over to you to get us started.
Thank you, Emily. Today we are going to cover quite a few things, so we are going to jump right into it. At the end of this session, the plan is that you will have some ideas on how to implement the new financial reporting standard for not-for-profits, ASU 2016-14. We're going to cover the impact of the revenue recognition standard for not-for-profits, talk about some lease and cash flow changes from some new standards that were issued, as well as understand some potential changes to accounting for grants and contracts with a new exposure draft that was recently issued. So, as I said, the agenda is pretty full today. We're going to try to cover the not-for-profit financial reporting standard at a little more higher level. I assume most of you have heard about it. We want to go into some implementation guidance and really start to plan how that's going to look for you and your financial statements going forward, and we're going to go through some examples there as well. We have a lot to cover, and so I don't anticipate we're going to have a lot of time for questions, but as we're going, please do use the Q&A feature because we will gather all the questions and respond to them at the end through either direct contact with you or put together a kind of a Q&A overview from all the questions that are received during the webcast. So please do use that feature, but we probably won't have a lot of time to actually cover questions on the call. All right, so not-for-profit financial statements. First polling question, and remember you do need to answer 75% of the polling questions to get CPE credit, and I know there's probably some people getting that before the end of the year. So how familiar are you with the not-for-profit presentation of financial statements, topic 958? Consider me an expert. I know enough to be dangerous. I read a few Insight articles, or I have ignored it entirely, hoping it will go away. So take a minute. We'll give you a few seconds to answer the polling question, since you do need to do that. in order to receive CPE credit. All right. See. All right, so the majority of you have some knowledge, and a lot of you still hoping it'll go away. Unfortunately, I don't think that'll happen. And we have a few experts, which is great too. And so what I want to do, this is good information to have, and I think we have the right audience, because we're going to do a brief overview of this, but then really get into some of the more meatier sections and do some examples and some guidance for you on how to implement this. Just a quick overview on project objectives. This was really the first real change to nonprofit financial reporting and since 116.117 came out, which was a long time ago. So this is really to update the current model and provide better user information on the financial statements. Really want to, they talked about the net asset classification. I think that was the big thing that got attention of most people, but there's also a lot of other things in the standard that are trying to provide more clarity to the users of the financial statements and better enable not-for-profits to display what they're doing and in a more consistent method, because the industry is rather broad, and so trying to make it a little more consistent on how things are reported across the not-for-profit industry. Just as a reminder, the effective dates for this standard fiscal year is beginning after 12/15/2017. So that's for calendar years beginning in 2018 or your fiscal year is 2019. That means for comparative purposes, we are currently in a period that you need to be considering this for your financial statements. So I think that's why it's important to kind of go through this now and start thinking about information that you may need to gather or things that you might need to think about differently for that comparative period. You can early adopt this if you are excited and want to get going. That's accepted, but there are some things that you don't necessarily have to present for comparative periods. You need to apply all the provisions, so you can't choose to do just the net asset piece and think about the liquidity piece later. You have to, if you're going to early adopt this, you need to adopt all provisions. But for comparative purposes, if you're showing comparative financial statements, you can choose not to adopt the expenses. So showing expenses by nature and function is now required somewhere in the financial statements, and Laura will talk about that a little later, as well as the disclosures on liquidity. That does not need to be comparative for when you adopt the financial statement reporting for the first year. Just things to think about as you're going through. So as everybody has likely heard, net assets are going from 3 classes, which we currently have: unrestricted, temporarily restricted, and permanently restricted net assets, to 2 classes, with donor-imposed restrictions and without donor-imposed restrictions. That doesn't mean that your permanently restricted and temporarily restricted net assets are going away. They will be renamed. You'll still have perpetual, so those endowment funds that you have that are going to be there with you for perpetuity, you still have those. You will still have donor-restricted assets by time and purpose, temporarily restricted, but they're all grouped together in one category with donor restrictions. And then I'll go through some of the disclosures that you'll still need to have as we go through this presentation. And then those without, and without, just like it does now, includes board-designated net assets. So right now, currently, they're in unrestricted. They'll stay in that category without donor restrictions. This is an example, a couple examples actually, of what your statement of financial position may look like under the new standard. The top example is the minimum requirement. So you are required to show both of those 2 categories without donor restrictions and with donor restrictions and a total net assets. So that's very similar to what we currently have, only it's 2 versus 3 categories. You are allowed, however, to disaggregate. And this is, again, where I think now is a good time to start thinking about this and talking about this with your board and the users of your financial statements on how much disaggregation do you want to have here. Do you want all of this information, or do you want to just have the two categories as required? And I think it's going to vary based on the users of your financial statements, and as well as the different restrictions that you have as an organization and what will make sense to show. So this is something that I think is going to be important to start thinking about now, so this isn't a last-minute scramble on how much of this information you want to show on the face of your financial statements. The next slide, this is the statement of activities, very similar to what we have now, except for there's 2 columns instead of the 3 that we typically have, and then the total. So with donor restrictions and without, and then we'll go through a little bit later in the presentation on the expenses. You can choose to show expenses by nature and function here on the statement of activities, or you can show that in the footnote. So Laura's going to talk about the presentation later, but that again will be a change in, maybe a change in how your statement of activities looks. So pretty standard here. There are some disclosures, not a lot of changes here, but some. The net assets without donor restrictions, you have to disclose the amount and the purpose of the board-designated net assets. So this hasn't been required in the past to talk about the purpose and the amount of those designated net assets, and that is now going to be required to do. You'll also continue to disclose, for those with donor restrictions, information about the nature and the purpose. But the focus is now on both how and when the resources can be used. So you, instead of just that distinction between temporarily and permanently restricted net assets, you're providing more information to the users to improve kind of the transparency and understandability about when you can actually use those resources, and that will go along with the new liquidity disclosures as well, just trying to make it more transparent on what are your actual available resources to use in your operations, and when are you able to use those things. So that's required disclosures of really focusing more on the how and the when. All right, we have another polling question for you out there, so make sure that you're paying attention now. If you want to get your CPE credit, we need you to answer at least 75% of these. So is your organization planning on early adopting the new standard? Yes, no, I don't know. I guess there's still going to be those people hoping it's going away. So I'll give you a few seconds here to answer the polling question so you get your CPE credit. All right, I'm going to guess probably not a lot of early adopters. Yeah, I was right. So some of you may still be thinking about it, and I hopefully this will give you some ideas on whether you're interested in early adopting or not. I think a lot of people want to wait and see how this shakes out, and a few people just want to get it done. So it'll be interesting to see. Some additional things to consider on those board-designated net assets, which are without donor restriction. You must have a policy in place for these designated net assets, even if you don't have any. So this, I think, is something to consider now. Start talking about what is your policy. And then the interesting thing is some boards may delegate the decision to designate net assets to management, and that's okay. There is a new definition in the master glossary about what are board-designated net assets. I think it's very self-explanatory, but they don't have donor restrictions, but they're self-imposed restrictions, and the board cannot earmark them for various different things, but that will need to be disclosed about what the purpose of the restriction is now, and you need to have that policy. So even if you don't have these, consider is it just the board that's able to designate the reserve or the future capital projects, or has that been delegated to management, and what is that policy? This is another thing that was, I feel like, kind of buried in a lot of what was happening in this new standard. Maybe it's like the tax bill or they throw something in at the last minute. But this, again, was something to clarify inconsistencies in practice. So there was several ways that organizations were reporting the release of restrictions where they had been given a donor-restricted contribution for the purchase of property, plant, and equipment, a building, whatever it might be. There was kind of some inconsistencies in how that was being accounted for. So the new standard is really clarifying the guidance and giving them basically one option on how you're accounting for this. You can no longer imply a time restriction if it's not designated by the donor. So the time restriction, the organization can't do that. It's only donor. And it removes the option for you to release the restriction over the life of the asset. So it's really saying once the asset is placed into service, your restriction is gone, and that's when you release the restriction. So in practice, right now, some organizations are saying, well, I'm going to release the restriction over the useful life of the asset, whereas now they're saying, once this is placed into service, you release the restriction at that point in time. So something to consider. It might not be applicable to a lot of people, but it was in there, and it kind of buried a little bit in all the other things that are happening in this new financial reporting standard. So if you've got those restrictions on or restricted contributions for the purchase of property, plant, and equipment, you need to account for it in the placed in service approach at this point when you adopt the standard. For those of you with endowments, you may be familiar with underwater endowments, hopefully not too many of them, but they did add a definition in the FASB glossary for underwater endowments. So really that is when you have an endowment where the fair value is less than the original gift value or the corpus. So that is now in the glossary, underwater endowments. And this standard requires additional disclosures regarding the underwater endowments. So you have to have a disclosure on what is the organization's policy on spending from underwater endowments, because under MIFA you are allowed to spend if you have an underwater endowment. You can continue to spend out of that and go into the corpus, but you don't have to. And so this new standard is saying, what is the organization's policy? And you need to disclose that. If you have underwater endowments, do you still spend out of them? Do you not? What do you do it to a certain level? So that needs to go in your financial statements at this point. You also need to disclose whether you did spend from any underwater endowments during the year. Was there any action taken? Which means if you had underwater endowments and it's your policy to spend from them, if you did that, you need to disclose that in the financial statements. If you didn't, you just need to say that as well. And then for each period where you have underwater endowments, you need to present the fair value of the endowments. So that's in the aggregate. So if you've got 4 funds that are underwater, you present that total of the fair value of those funds. The original gift value, so the aggregate of what was the total gift value of those 4 funds, and then the difference is the deficiency. So currently in practice, under the guidance now, you only have to report that you had underwater endowment funds and what the total value of that deficiency is. This is just adding the additional steps 1 and 2 of the total fair value of those endowments as well as the original gift value. So it gives the user of financial statements a little better idea of what the total is, and if this is a large part of the endowment fund or not, and maybe it's just a one fund that's pretty small. So that's just giving that whole and aggregate total. And the following slide is just an example of that. You can do that in a table, or you can just do it as part of your endowment footnote. You can just add it to some of the text there, put a paragraph in, and this shows that they had 3 funds. The original gift value was $3,500. They have a current value of $3,300, so there's a deficiency of $200. It's pretty straightforward, and you can do it in this format, or you can choose to do it in a table if that's easier. this slide shows the presentation of donor-restricted endowment funds. So currently in practice, if you have a deficiency in your endowment funds, in your endowment footnote, you note that coming out of unrestricted net assets. So you're taking it, if you have appreciation, usually it sits in your temporarily restricted net assets until it's appropriated for use. If you've got a deficiency in your fund, that comes out of your unrestricted column. Under the new guidance, that stays within your column of with donor restrictions. So now you're not taking that deficiency out of your unrestricted fund, or your without donor restriction. It's all in one fund, which I think makes a lot of sense. And so I think FASB got this one right. But this shows two different endowment gifts and what the current gap you have. So if you've got a gift A with $105 million corpus amount, or your original gift value, and it's got a $5 million deficit, so you have $100 million at the end of the year. Under the current gap, you report that permanently restricted amount as $105 million, because that's your original gift value, and that $5 million loss comes out, or unrealized loss comes out of your unrestricted. So at the end of the day, that's what you're doing. But then under the new standard, you just have $100 million in net assets with donor restriction. So it takes that difference between the permanently restricted and the temporarily restricted out of there. You keep that $5 million in the with donor restricted assets, which makes sense because those are, even if you've got an unrealized loss there, you still have that. And then, so it's just recorded at the $100 million. You've got a similar, in gift B, you've got $75 million in original gift value, but you've got an increase of $25 million. So you have the $100 million again. And how that would currently be shown is $75 million in perm restricted and $25 million in temp restricted, because you haven't released that or appropriated that for expenditure yet. So it's all sitting in a restricted net asset account, either permanently or temporarily. In the new standard, it's all going to be in that with donor restricted category. So I think this presentation actually makes more sense when you do have those endowment funds that are underwater. So this was a good move by the FASB, I believe. All right. Next up, Laura, I'm going to turn it over to you to talk about liquidity and availability.
Thanks, Liz. So there are two new disclosure requirements required by the standard. So the first is your organization will be required to qualitatively describe in the notes to the financial statement information that's useful in assessing the liquidity of resources or the maturity of assets and the liabilities, as well as how your organization manages its liquid resources available to meet cash needs for general expenditures. And so those general expenditures that are coming up within the next year. Second, your organization will be required to disclose the availability of financial assets as of the date of the statement of financial position and what you have available to meet those needs for your general expenditures in the upcoming year. As it relates to the qualitative information, in order to prepare for the disclosures, here are a few things to think about. If you have a formal cash management policy, this is the time to get it out, review it, ensure it's still appropriate for your organization, and probably check to see if you're following it. If it's necessary, make any changes that are needed. As you'll see from the example that we'll look at, this policy will be disclosed in your footnotes to the financial statement. So you probably want to make sure it's still appropriate and what you want it to be or what you want others to see. Take a stab at drafting this footnote. You don't need to wait until you implement the standard, but you could draft the footnote based on your current policy, see what it looks like, start sharing it with the folks that care about your financial statements, whether it's your management team or the board of directors or perhaps other users that might be interested in seeing what these changes are going to, how they're going to impact your financial statements. A couple of other considerations. I think it's really important. Liz talked about the disclosures around board designations. I think this is a good time to determine what board designations you've had in the past, if any, decide on whether or not they're still applicable to your organization. Consider the type of supporting documentation you have to support those amounts. Do you have board approval to support the designations, or even a lack of a designation? So think about, are there meetings or board approvals that need to happen in order to have the evidence you need to support your footnote disclosures? Here's an example. It's a really simple example of a qualitative disclosure. You can see it includes the organization's policy for liquidity and information on the amount of cash and what those funds are invested in. So that this policy or this organization is using short-term investments and certificates of deposit for its excess cash. It even has mention of a line of credit. It's pretty straightforward and could probably be pretty easily adapted to just about any organization. Let's see. This is another example of a disclosure that could be used to display this qualitative information. It's a little longer, a little bit more information, maybe more than you would actually want to provide, but something to at least get you started. The next step is thinking about your quantitative information. So it's pretty important to start gathering this information, thinking about the best format that's going to work for your organization and the users of your report, and making sure that you have access to this information. It's important, too, to remember that availability is affected by the nature of the asset, any external limitations imposed by donors or agreements that you've entered into, and even board designations. This is a sample of a worksheet that you could start using or could be used as a starting point. You can see down the left-hand side of this worksheet, it lists the various financial assets that you would probably identify in your statement of financial position. Then for each line item, you should consider any limitations that you have on those assets. For example, your cash account balance might have some restrictions related to it. You may need to have cash set aside for a letter of credit. You may have received a contribution that's for a building, and so those amounts wouldn't be available to be spent on general expenditures. As it relates to your promises to give, any pledges that you might have, you need to step back and evaluate which of those are expected to come in within the next year, and are those amounts available for general expenditures? And that could be a program expense, but if it's something for a building or something or an endowment, those amounts should be backed out and not included in the net asset or the amounts that are available for general expenditures. So you can go down each of those financial asset line items and pull out the information or the amounts that aren't available for your upcoming year. And that will give you a good starting point for a footnote. This is an example using the gross approach to displaying this information. You can see here it starts off and lists out the financial assets, cash and cash equivalents, accounts receivable, investments. And these amounts likely would agree to the amount on the statement of financial position as a starting point. And then below, they have listed out the types of things that would pull amounts out of the amounts above. So that would be that column on the previous slide where amounts above aren't available for general expenditures. And I like this format because it actually, as an accountant, it ties back, the first part ties back to your statement of financial position, but then it also gives the reader of the financial statements kind of your thought process on why items wouldn't be available for general expenditures in the future. This next method's a little simpler. It's actually, we've been calling it the net method. It would actually use that final column from the worksheet that I shared with you and just show of the cash balance, only $33,000 is available. Here's what we have in accounts receivable. These are the amounts that are available. Still comes down to that total amount that's available for general expenditures, but a little different approach. So something you need to step back and think about what's the best for your organization. The next area relates to expense reporting. So So all organizations will be required to present their expenses by nature and function under this new standard. Where this information is displayed in the financial statement is up to you. You can provide this information in the footnotes, a separate statement, or within the statement of activities. The standard also requires disclosures around the methods that were used to allocate costs, and it includes some new examples relating to allocations of cost, allocating costs. Here's an example of a statement of functional expenses. You'll need to decide on the level of detail to provide. For example, down the left-hand side, what are the appropriate expenses for you to list out? I don't think we should go crazy. I think any more than 10 or 15 line items, I think 15 is on the high side, is more than sufficient to provide the user of the financial statement the information they need to evaluate the expenses. I think you'll also need to back up and look at the program activities. It's a great time to reevaluate your financial statements and identify, are the programs that we've been displaying the most appropriate for our organization, or is it something, have our operations changed, and do we need, or is this a good time to reevaluate and determine whether or not those are the most appropriate? This next slide might work for a fairly simple organization. You could show your expenses in a couple of, right in the statement of activities. So if you had grant activities or grant-making activities, you could show the amount of your grants, your benefits and occupancy, and come down to your programmatic expenses and do something very similar for management in general. And this could fit right in the statement of activities, so an easy approach for a simple organization. So this is also a good time to step back and review your allocation methods that are currently being used to see if they're appropriate. I'd go back and read the examples in the standard to see if your methods are consistent with the changes that have been made. I think it's really important also to develop a formal policy and to get that in place so that you can have a good starting point for a footnote disclosure. And I think it's a good time to also make sure that if you do have a policy that you're following it and putting your financial statements together. The last area in this standard relates to investment return. After adopting this standard, investment return will be required to be shown net of expenses. We've had that option in the past, but we would also have to show the gross amount and the netting expenses in the footnotes. Under this standard, external expenses, so those outside expenses that you're paying, whether it's to a trustee or an investment manager, and direct internal expenses will be offset against investment earnings. So when deciding on internal expenses to include, these expenses should be involved with the direct conduct or the supervision to generate investment return. So right now, I think it's time to take the time to ensure that you can easily identify any direct internal expenses that will need to be reclassified against investment return. All right, it's time for another polling question. So which of the components of this new standard will be the most useful to the users of the financial statements? Is it grouping the net assets into 2 classes versus 3? The functional expenses, or expenses whether it's functional or showing investments net? The liquidity and availability disclosures, or all of the above? All right, looks like over half of the group thinks that most of them will be useful to the readers of the financial statements. I think the liquidity and availability one's going to be the hardest to get pulled together appropriately, but I do think the users of the financial statements will find it useful in their evaluation. All right, so now we're going to move on to revenue recognition. So this standard, man, it feels like it was issued a really long time ago, and we had a long time to get it implemented, but implementation dates are around the corner for some of us. So The standard was issued to help ensure that revenue is being recognized when an organization transfers the goods or its goods or services. So it's out there. Let's see. The core principle. This guidance outlines a 5-step process. You can see those steps they're laid out there at the bottom of this slide. We thought the best way to cover this new standard is to walk through an example to help you understand each of the various steps and how they might be applied to transactions within your organization. The AICPA has a committee that has been looking at a variety of different revenue recognition questions or transactions for a variety of different industries. In the not-for-profit industry, one of the types of transactions that was submitted to this committee for kind of an evaluation was housing and tuition at a college and university. And they put together in August of 2016, or July or August of 2016, a really nice summary that's available to the public on how to step back and evaluate that type of transaction through this new accounting standard. And so we thought it would be good just to walk through that and take it through each of these 5 steps. Not every single organization, of course, will have housing and tuition. But you may have a similar type of transaction that might be useful in helping to interpret this. So the first step is to determine whether or not you have a contract. So a contract's an agreement between 2 or more parties that creates an enforceable rights and obligations. So contracts can be written or oral or implied by customary business practices. So just because it's not in writing doesn't mean you don't have a contract. Best practices and processes for establishing contracts with customers vary across legal jurisdictions, industries, and your various not-for-profit organizations. Your organization will need to consider such practices and processes and determine when an agreement with a customer creates an enforceable right and an obligation. So let's think about a non-refundable enrollment or housing deposit that a college or university might receive. So under the current standards, these amounts are generally recorded as revenue when received because they're non-refundable. And let's see how this actually changes under this new standard. FINREC, which is a body, they're not a regulatory body, a standard-setting body, but they often help. They're a group of AICPA folks that help interpret accounting standards and give best practices and recommendations to preparers of financial statements and auditors. So they recommend that in cases where a student pays the institution a non-refundable deposit to secure a spot for enrollment or housing, this transaction generally gives the student the right to receive instruction or housing as applicable and obliges the institution to stand ready to provide instruction or housing. So there's a chance, just like we all did, right? Sometimes there's a chance the student might not enroll or move onto campus, and as the consequences associated with a non-refundable deposit will be forfeited. This standard provides that if an entity expects to be entitled to a breakage in a contract liability, the entity should recognize the expected breakage, that amount, that deposit, as revenue in proportion to the pattern of rights exercised by the customer. So because whether or not a student actually enrolls or moves into housing are binary events, there are no other rights being exercised by the students. So FINREC believes that institutions would not record this deposit until the student's right to enroll or be provided housing expires. So that's different. You can't record the revenue under this new standard when you receive it. You have to consider that deposit that's being made for housing in the total cost of housing or enrollment. That's different. So step 2 is looking at whether or not there are a couple of different performance obligations in the contract. So in this example, we have a deposit for tuition and housing. So you'll need to decide under any of your contracts whether or not they are contracted together in a single contract or whether or not there are 2 separate contracts. And for the purposes of applying the new standards, 2 or more contracts can be combined if 1 or more of the defined criteria are met. Those criteria are if the contracts are negotiated as a package with a single commercial objective, the amount of consideration paid in one contract depends on the price or performance of another contract, then the services promised in the contracts are a single performance obligation and you can combine the contracts. If none of those criteria are met, then the tuition and housing would be treated as separate contracts. And so FINREC believes that more often than not, tuition and housing would be separate services with performance obligations and thus pulled apart and accounted for separately. The third step is really identifying the transaction price, right? And this can be broken up into 4 different kind of sections. You have the actual price, the amount of consideration that's payable to the customer, whether or not you're providing a discount or a coupon, the right to withdraw from the transaction. So in this situation, if someone withdraws from class during a semester or quarter, and then considering the collectibility of the amount being paid. So in determining the price, you need to include all the consideration that's expected to be entitled for the services provided. So your institution may offer students different rates based on the category of students. You might have an in-state student, an out-of-state student. You might have a veteran. You might have a variety of different types of contract prices that you might use for different categories of students. The contract price is what you're entitled to when the amounts, whether or not the amounts can be paid for others, not just the customer. So whether it's just your student or their parents or their employer that might be paying them. So it's the cost, the price of your service that you're for that category of student. And then when you think about consideration payable to the customer, this would include cash amounts that an entity pays or expects to be paid to the customer, and it includes credits that can be applied. So if you have a scholarship program, you need to reduce that transaction price by the amount of the scholarship that the institution is providing. So that will reduce your revenue amount. Step 3 is thinking about the right to withdraw. So most institutions have an add or a drop period where students may receive full or a partial refund based on the number of days that they've attended. In many of these cases, consideration will have been received from a student in advance. When that's occurred, the consideration is deemed variable and you must recognize a refund liability. So you've got to project ahead of time based on your students if you think you're going to be providing refunds. This liability would be measured at the amount of consideration received or receivable that you don't expect to be entitled to. So that's a little different, thinking about what might I have to give back if someone's going to leave, kind of estimating that. It's almost like a return if you were a retail store. There are 2 defined methods for establishing or estimating variable consideration. And the one that's probably most appropriate for this example is the expected value method, which is the sum of the probability weighted amounts in a range of possible consideration. So you can use a portfolio approach as long as you believe your estimate is your best estimate of this amount and trying to determine what your liability will be. Let's see. Finally, you have to think about collectibility. In order to record revenue for these types of transactions, just even to record revenue at all, you have to believe that you're going to be paid for these services. When you're evaluating your receivables, it won't change your revenue amount. It'll be very consistent with what we're doing today and looking at the future collectibility and putting an allowance against any amounts. So that process will be the same. It won't impact the amount of your revenue that you'll record. So once you've kind of determined what the price is by looking at the discount and the right to withdraw, you need to step back and determine when that revenue will be recognized. So it's allocating that transaction price to the separate performance obligations in the contract. So if we're back thinking about this transaction, we might have determined a certain amount, and part of that's for housing and part of it's for tuition. So we have two different performance obligations. So we need to determine how that price would be allocated. So the best evidence is looking at if one of those items you have a price for whether or not you sell it on a standalone basis. So an example I could think of is if you provided a tuition for a student who lived on campus, and it would be the same tuition as someone who was commuting into campus. So you probably have a really good estimate for what the tuition price is, and then probably anything else would be housing. All right, so then thinking about when revenue actually gets recognized. So this standard allows you to recognize revenue over time. And because when we think about how tuition and housing goes, you're providing those services over time. And so you would probably recognize this as those services were being provided. This new standard also comes with a variety of different disclosure requirements, and those disclosures depend on whether or not your organization is classified as a public entity or not, and they may or may not include some of these items that are listed here. I think it's really important to evaluate where you're going to fall in the disclosure requirement to ensure that you're able to pull the necessary information for the disclosures. The effective dates, if you're a public entity, you can see we actually had a 1-year deferral. But if you're a public entity, the implementation is right around the corner. If you have a December year end, these standards are effective starting January 1st, 2018. Or if you have a fiscal year end, 6/30 or later in 19. If you don't, you've got a little bit of time. Another polling question, what type of impact are you expecting the revenue recognition standard to have on your organization? No impact at all. We have a couple of revenue streams that we'll need to review. We have a number of different streams of income to evaluate, or I just don't know. And that might say I just don't care. So, all right. All right. So, about 30% with no impact at all, and probably a good spot to be. A very contribution and investment income type organization, and then a few other organizations, under 50%, that'll have to walk through a few transactions. Good. All right, Liz.
All right, thanks, Laura. So the next thing we're going to cover in the same vein as revenue recognition is the exposure drafts that FASB issued on grants and contracts for not-for-profit entities. And this is something that I think may help those of you who are wondering if you have something that's going to fall under that new revenue recognition standard in 606. This was open for comment through November, and they had about 46 letters, but they really wanted to address some subjectivity in the guidance on contributions versus exchange transactions. And many of you, when this Topic 606, the revenue recognition standard, came out, there was a lot of discussion about where government grants fall, and is the government do you have a contract with the government? Is the government a customer? If you're receiving a bunch of federal funds and you have all these contracts, is that going to change how you recognize the revenue? Is that going to pull you into the disclosures that are required? So this addresses some of that and tries to be more clear on what is a contribution versus an exchange, and if you've got a contribution, is it conditional versus unconditional? So 2 steps here, really. First, deciding whether you've got a reciprocal or a non-reciprocal transaction, and is it an exchange transaction or is it a contribution? And many, in the past, I think many nonprofits are saying, if I've got a contract with or a grant with the governmental agency, it's an exchange regardless of really looking at it at all in substance, because the government doesn't give contributions. And I think this exposure draft is trying to really steer away from that a little bit and say, is the government receiving direct value in return? Is there really a reciprocal transaction there, or are you providing kind of a service to the greater good, and would that then be a contribution? So I think for most government grants, you're saying, yeah, well, it could fall under this guidance into a contribution, and then saying, well, is it conditional versus unconditional? And there's some guidance there on whether there's a right of return or a barrier. You have to have both for there to be a condition. And so this, the next slide here talks about the first step. Is there a reciprocal transaction here? And it walks you through a little flow chart saying, yes, there's an exchange, and therefore you are going to be scoped into 606, which is the new revenue recognition standard, or no, there's really no exchange, so you've got a non-reciprocal transaction, and that puts you into the contribution guidance, which therefore scoped out of the new revenue recognition standard. So this is pretty much step one. And then if you determine that you do have a non-reciprocal transaction, so you've got a contribution, then you need to look and see if you've got a conditional contribution. And right now, again, the guidance is very subjective on this. This is trying to put in a little more clarification about what is a condition, and the conditions have to be both a right of return. So if you give money to someone and you don't spend it, they have to give it back, and there has to be some clear barrier. So is it, that they won't get the money until they do a certain thing, and both of those have to be there in order to have this condition. So ultimately what this exposure draft will do for most of those government grants is put them back into a contribution, so scoping them out of the new revenue recognition guidance, but then saying that they're conditional, because most of the time if you don't spend that money, a lot of them are cost reimbursement, so you don't even get it, or you have to give it back, and there's typically specific reasons that you're getting those funds detailed in the grant guidance, which therefore then gives you that barrier. So this exposure draft is pretty short and sweet, but if you have this situation where you're unsure if you've got a contribution or exchange transaction or a conditional contribution, hopefully this will provide a little more clarity, and then you'll know whether or not you have to go to that new revenue recognition guidance and deal with that. So this should, what FASB is saying, be coming out in the first quarter of 2018 if they have their way, in order to have this in place when the new revenue recognition standard becomes effective, so that you have this clarifying guidance in place. So I think this will be a good thing ultimately for most organizations, and giving some more clarity around this guidance. Next, we have leases, Laura.
Yep. So just a couple of reminders about the lease standard. If you have a large number of leases out there, you want to make sure that you've got some processes in place in order to gather all of the necessary information in order to implement this standard. This new standard requires that all leases longer than a year will be recognized as assets and liabilities in the statement of financial position. And that's different. Right now, operating leases are just a disclosure in your commitment footnote, and so now there will be an asset and a liability under the standard reported in the financial statements. The asset that you will record in the financial statement represents a right to use an asset and will be amortized over time. And then the liability will be worked down over time as payments are made on the lease term. There's a new term now. Capital leases will be known as finance leases, but operating leases, that term still carries on. This slide just summarizes how the leases will impact the statement of activities or your income statement. So you'll see on the balance sheet both financing leases, currently known as capital leases, and operating leases. Both on the balance sheet you'll have an asset for the right to use and a lease liability. For a finance lease or a capital lease in this income statement or your statement of activities, you'll have amortization expense and an interest expense. And then in the statement of cash flow, you'll see payments for principal and interest. For an operating lease, you'll just have one line item. It'll be an operating expense. You won't see amortization expense and interest expense, but one line item coming through your income statement, and then just lease payments, no interest payments or debt payments on your cash flow statement under an operating lease. So different how those are flowing through. A reminder about the effective dates for this standard. So if you're a public entity, that means you have Conduit Debt. It's effective for your years beginning after December 15th, 2018. So that would be a calendar year 2019 or your fiscal year 1920. If you're not, you've got a year longer to prepare for this. And early adoption is permitted for all organizations. All right, Liz, last one. Let's see. Oh, I've talked about this. Make sure that you've got your inventory of leases so you can make sure that you've got everything accounted for. And this doesn't apply to leases under a year. And if leases aren't material to your financial statements, it's always a consideration that you should make before implementing the standard.
All right. We are on the home stretch here. The last thing we wanted to just bring to your attention is a new ASU, which was issued late last year, 2016-18, on the statement of cash flows and restricted cash. This one's fairly straightforward, but again, it's clarifying some diversity in practice where you've got restricted cash that's not included on the statement of cash flows. So this is just saying that you need to include all cash equivalents, including restricted cash, on the statement of cash flows. One thing it doesn't do is define what restricted cash is, but this includes a lot of times if you've got, like Laura mentioned earlier, something the restricted for a bond, and these may be things that you're thinking about in your liquidity footnotes as well that you can't use. It's restricted for a specific purpose. You may have it on your separated out on your statement of financial position, and so it's not sitting in the cash balance, but that does need to go on your statement of cash flow. And so here's just a quick example of that. You've got cash and cash equivalents, restricted cash, cash restricted for other long-term assets, and a total there that will reconcile back to the ending cash on your statement of cash flows. So may not make a difference to you if you don't have this, but just to be aware of it, does need to be included. The standard is effective for public entities for calendar year 18 or fiscal year 19, and then for those that are not public entities, you've got another year, so it's calendar year 19 and fiscal year 20, but should be fairly easy to incorporate. If you do have restricted cash, you just have to add that into your cash flow statement, so it shouldn't be a lot of work there. And that is all we have for you today. So Emily, I'll turn it over to you.
All right. Well, you guys certainly covered a lot of information. If anyone has any questions, we will still hope to get to your questions after the webcast, so please go ahead and submit those in the Q&A. Thank you, Liz and Laura, for a great presentation. As a reminder, if you attended today's webcast in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.